Good afternoon. Well, over the last couple of years, I've simply had hundreds and hundreds of conversations with advisors, and what I hear as returning topics is your clients are concerned about some sort of correction in the market. Am I wrong? That's just, if you read the papers long enough, and yield. And I think they're focusing on the wrong thing, because really it's about dependable long-term earnings growth. That's hardly surprising, because at Hyperion we've been talking about this pretty much for 23 years. But why? What is it about long-term earnings growth that they should be really being focused on? It's really two components. It's about creating an environment where they get long-term capital appreciation and they get preservation of capital components. And that's really the part that we're talking about when we talk about dependable long-term earnings growth. Let me just set the scene. The 30 years up to the GFC were terrific years for just general average companies, old world type businesses. We had GDP growth built on a couple of good, strong factors. There was the baby boom that came through. Now, demographics have created a powerful force, put a lot of workers into the workforce, lifted GDP growth. You combine that with the number of women that came into the workforce. In some Western economies, they nearly doubled the number of women in the economy. Interest rates were falling. Debt was taken on. It brought forward GDP, and combine that with the uptake of technology, digital technology, productivity increased. So companies, very average companies, over a very long period of time could just lift, the rising tide lifted all boats. They were sitting there, they were pumping out reasonable sales growth, combine it with some financial leverage and operating leverage, and they pumped out earnings growth. But a lot of that came to a screaming halt at around about 2008. And you can see it in your clients. The baby boomers started retiring and they're leaving the workforce. The participation rate is lowering. We've got too much debt. Inflation rates are down now towards 1% in Western economies, and the feds in those various economies are targeting 2%. They're afraid of deflation. They're going to keep interest rates low. They're going to throw helicopter money out there. So debt's a real problem. At some stage in the next 20 or 30 years, there's going to have to be a deleveraging. So what was the tailwinds up to the GFC have actually turned into headwinds, and a lot of average businesses are going to find it very hard. These are some of the factors. We know about the high debt levels. There's this rising wealth inequality. So the top 0.1% of the American wealth owners are now equal to the bottom 90%. And that crossover has only recently happened. And that has pretty serious implications for consumer and the ability of the consumer to get them out of problems. We have natural resource constraints. We just can't keep consuming the level of natural resources that we currently do for the next 100 years. At some point, the brake is going to go on. I think you can see the trend of what I'm talking about here. I'm not talking about next year. I'm not talking about growth versus value from this year to next year. I'm talking about the next 20 to 30 years. And for a lot of your clients, that's their horizon. 60-year-old people are going to live to 80. So they've got to start thinking about this stuff now and not hopefully tack together a couple of years in a row to make it all work. Monetary tailwinds I've discussed, and I won't have time to get through technology, but that's really going to put a cap on inflation. So we're in an environment with low GDP growth, low inflation, low interest rates for a very long period of time. Our global portfolio, I'm just going to go through a couple of names and then focus on one in particular, sort of lift up the hood so you can see how we think about delivering capital growth, but also capital preservation, which is a deep worry for your clients. These are just some outstanding companies. You know the names, or you know most of the names. PayPal in 21 years has basically overrun the digital payments market. Together with MasterCard and Visa, cash is really on its way out. Google and Facebook are just scratching away at TV and papers, and you can see what's happened to TV and papers. It's really obvious. There's still a lot of money in advertising still sitting there, but it's slowly being dragged away because the eyeballs, the revenue follows the eyeballs, and that's where all the eyeballs are. E-commerce, you heard previous speakers talk about the issues with shopping centres. So you've got businesses like Amazon and Wayfair and other, it's relatively unpenetrated at the moment. Everybody thinks online shopping's taken over the world. It's not even close. It's still got a long way to go, and that has major implications for some of the older world businesses. So I'm just going to focus on one area, and that is the real estate sector. Now, most of you who've followed Hyperion for a long time know that REA, realestate.com.au, was one of our original investments. We've held it right from inception. We bought it under $1. It's nearly $100 today, so it's a 100-bagger. That's what every fund manager wants, is a stock that they can hold for a long period of time, can compound, earnings compound over long periods of time, and that's the wondrous outcome for the clients. In a global sense, that online property portal market is really interesting, and we've scoured the world, and in our global portfolio I've picked Rightmove to talk about today because it's not one that most people would understand. And Rightmove is the English equivalent to REA, that it is the lead number one player in the English property portal market, and it outcompetes the rest of the other two competitors quite substantially, a bit like Australia with Domain. I'm just going to set the scene here. So obviously you all remember 3 years and a bit, I think it's about a month ago today, Brexit vote. And it knocked the stuffing out of the English property market. So those two graphs show property transactions. Everything was starting to recover post-GFC, post-European debt crisis. Bang, the brake went on at that Brexit vote. And the same with prices. They were starting to recover, and then just as they were starting to recover, Brexit vote, and the growth slowed off pretty quickly. And what did we do at that point? We bought more of the company, and we've been buying ever since. We've managed the downside. The downside is it's a subscription model. It's not like the Australian model for REA. So REA is a vendor-paid advertising, depth advertising market. The vendor pays it. In the UK, the agents, it's an agency model, agency subscription model, they pay per agent. And so what you're really managing is the number of agents, because that also provides you with the downside protection. As long as the number of agents stay about the same, then the revenue will stay the same. And what's the upside? It's the customer value proposition to those agents. Extra services that they'll pay more for. The average revenue per agent, and they've been increasing that quite dramatically over the years by rolling out more services. Things like referrals of customers to an agent looking to sell a house. Now that's valuable to agents. We've polled Australian agents and UK agents, and we think it's worth about 500 Australian dollars equivalent in pounds to an agent to actually get that referral. That's valuable. And interestingly enough, what's worked really well for REA in Australia, which is the vendor-paid subscription, the advertising model, the depth like eBay model, hasn't been implemented over in the UK, and REA haven't done the agent referral model. So there's some upside in both of them. But let's look at what actually it's done, is look at the earnings over that period. And look at the price appreciation on the right-hand side. This has been a really good investment. Now, the takeaway I want to leave you today is that there's a lot of old world businesses struggling out there, and they're trying to come up with ways to say to investors, we're an annuity-based business, you should value us highly. And they're turning what previously was a transaction-type business model into an annuity model. Think of a retail business that charges you a monthly fee for all the home delivery that you could want. And what I want to highlight to you is that that's a retail subscription model, and you've got to compare that against someone like Amazon that not only does that, but also gives you free video subscription, gives you free music. Compare it to a B2B subscription model, which looks like Microsoft Office 365. Who here, once you've subscribed to Office 365, would dare go back to your office and say, you know what, actually we're going to stop using Microsoft Word, Excel, PowerPoint and all those other services, because what else is there to replace it with? Amazon Web Services, AWS, 5 years ago had 39 major products delivered to their clients and now have over 180 products delivered. That's just continuing to delight them, the customers. So you need to understand the difference between that. And luxury products, I've put it in there because men who'll pay $600,000 for a Ferrari and wait for years in a queue, that's like an annuity stream. In the middle of the GFC, when Ferrari came down 4% in order numbers, the rest of that luxury market came down 40%. That's sort of that capital preservation component I was talking to you about. So what I'm just going to leave you with today, We're very focused on this part, long-term earnings growth, because we think that's what's really important to your clients